I now hand the conference over to Mr. Amit Bakshi, from Chairman and Managing Director of the company. Thank you, and over to you, sir.
Thank you. Thanks everybody for attending the call. Very good evening. Let me start by saying how things moved from quarter one to quarter two. At the macro level, we are almost back at around 90% of work. The footfall at the doctor's clinic have also more or less come to the normal levels. So I would presume they are at around 90%. The initial thought which we had when we opened the quarter one call, I remember that there could be a structural change going forward. Though we didn't have the numbers at that point of time to really speak for it, but we were quite hopeful that going forward there might be a structural shift in the way IPM has operated. As we are moving forward, we are seeing that becoming more clear. The trend more or less continues. The biggest emerging trend which we expected was the growth in VLM. If you remember, the quarter one growth from the market was -6%. But we were quite hopeful that the way things are shaping up, VLM will be a big jump. We can further tell you that we feel that immunity would be a target TG in itself, maybe in the coming years. So we see a continuous growth on that side month over month. Even the quarter three was in good healthy teens. So that's one change. Cardiovascular diabetes continues to be very robust. Cardiology, we are seeing the growth in strong double-digit growth. Even in diabetes, we are seeing a strong double-digit growth, but because of some value erosion, it is not there to be seen on the value side. Other than this, we also feel that COVID has actually, while the numbers in a diabetes chamber, doctor's chamber, are almost coming back to where they were, but surprisingly, we see more new patients coming in. So maybe, we always knew in India 50% of patients don't get detected. This could prove to be a shock, where everybody went ahead and tried to diagnose themselves. So we are seeing a great significant jump in the new type 1 diabetes patients who are reporting to the doctor's clinic. The same is true for hypertension also. So there is an increased awareness, what we were talking in the quarter one. Plus, things are getting normalized because of it's been quite long. We also talked about the digital trend. So digital trend did pick up. It is still pick up, but we are back to a very large level of physical meetings. So we consider that digital is now a permanent part of the overall patient's consultation, but it is not as overwhelming as we had thought in the last quarter. As for our performance, we have the PowerPoint presentation is there for everybody to see. And just like to highlight, the performance has been quite robust, and it has not only come from one direction. Almost all the engines have started firing. So that's it from my side. I'm happy to take up questions now.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Simranjit Bhatai from SMC Global. Please go ahead.
Yeah, thank you for giving me the opportunity. Sir, I want to ask 2-3 questions. First of all, in the FY20 annual report, which I was looking for of your company, your traveling and conveying to launch is close to 80 crores, which constitutes 7.44% of the revenue. Can you explain this from where this high number is coming and why this are we doing something different on it? Means when I see your peers, they are having close to 1 or 2 or might be 3% of the traveling expenses. So this looks quite big number. So can you explain on that part first?
Would you please complete your questions and answer you one for all?
Okay, thank you. Yeah, sure. And sir, second question is, your sundry receivables in FY20 was close to 156 crore, which was a jump of close to 48 crore from the past 4 years to 156. And right now in the 6 months it is close to in the FY21 it is close to 195 crore. Can you kindly elaborate on this part also? And
Sure.
And sir, third, like in FY21, in the Q1 of FY21, you have stated that zombies will start contributing close to 40 CR for the full year of FY21. Can you give some guidance on that part also?
Yeah, sure.
Yes.
So, as far as FY20, I don't know about the other companies, how do they present their numbers, but the large piece of this cost is basically the traveling allowance which our people claim. And we are roughly all put together around 3,200, 400 people in the field, around 2,400 representatives. So that's where it comes from. It's a completely normal expenditure, which is a part of everyday traveling allowance. As far as the debtors, yes, you're right. Our debtors have gone up. So one explanation is that with growing sales, debtors do go up over a period of time. The major change which you are asking is one we have already explained, that we were at 14-21 days cycle, which we moved to 21 days cycle. So when I say 21 days cycle, it is not from the date of billing. It is basically when the good is received. So then there is a lag of around 8-10 days. In the COVID era, that lag actually got little more. But having said that, if you look at the OCF, now you see in the second quarter we are closing at around 80-85%. And by the end of the year, we should be at the same level of around 85%. That's what it looks to us. But I think the debtors are going to decrease from here. I will not give you a number, but our target for the next year, first quarter, is that we come down to around 40 days kind of number. So depending upon the sales, we can then be able to calculate. Okay. The last question was about zombies. Yes, we are right there. We will be very near to 40 or exceeding 40. We remain confident, and the numbers are also on the same line.
Okay. Done, sir. Thank you. Thank you for giving the answer. Thank you.
Yeah. Thank you. Ladies and gentlemen, if you wish to ask a question, please enter star and 1 on your phone. The next question is from the line of Abdul Puranwala from Anand Rathi. Please go ahead.
Yeah, sir. Thank you for the opportunity. So my first question is related to gross margins. So gross margins for the second consecutive quarter was slightly low if we have to compare with the first half. So would this be a function of the vitamins and the OTS contribution being a little higher in the quarter, and that's why we see some impact in gross margins?
Yeah, so look, the healthcare business is very different from our core business. So there, let us talk about standalone. So standalone numbers, we have always been in the same range. If you look, our range has been 17.5 to 18.5, more or less here and there. So we continue in the same range.
Sure, sir. And in your opening remarks, you mentioned that nearly 90% of the promotional activity is back to pre-COVID level. So, but if we again see the other expenses portion where your large part of your promotional expenditure would be sitting, I think in terms of the absolute spending, we may not be in the Q2 may not be at the par level or as compared to last year. So do we see this cost increasing going ahead?
Yeah, look, cost could be looked into in two manners. One is if you compare it from the last year. One is you compare it from the percentage of sales. Because when sales grow, the cost also grows together. So when you look at from a percentage point, we are 2% less this quarter. But there is no way we can tell you that there is going to be any cost reduction. The costs are going to remain normal. This is what I spoke in the first quarter also.
Okay. And any new launches are we targeting for the second half, or how should we see FY22 if we have to see the growth? I mean, basically, if we have to divide between price, volume, and new product launches, so how should our growth look like maybe for FY22 or for the second half? If you can provide some rate, that would be helpful.
Yeah, just give me a moment. Just a moment. Yeah. Okay. Okay. So I'm just sorry. I just wanted to confirm certain numbers. Look, we are having some very interesting launches starting from December this year, extending to June of the next year. The pipeline is very rich. We haven't seen this kind of pipeline in the last 10 years. And this is something which we've been talking about in the last couple of years, that between 21 to 23 we will see large opportunities in terms of products coming in. So we remain positive, and that is the reason we typically mentioned in the presentation that we have visibility of launching 7 products, which are a mix of in-license as well as out of patent and some formulation development R&D, which we think will do good. So that is the outlook for the new launches. Now, from a sales point of view, gentlemen, look, this structure is very beneficial to our portfolio, and we feel that this structure is here to remain. From structure, I'm talking about the therapy mix which we are talking about. But look what has happened. Number one growth therapy, number 2 growth therapy, and number 3 growth therapy. And these are all large therapies. I'm not talking about small therapies. The largest and the top 3 growth contribute 80% to our portfolio. So we remain positive for the coming years also.
Sure, sir. And just on the growth breakup, if you could provide, that would be helpful.
Yeah, I'll just get that number and I'll get back to you.
Sure, definitely. I'll move back on the queue. Thank you.
Before the call ends, I'll inform.
Sure. Thank you.
Thank you.
Thank you. Participants, if you have any questions, please enter star and 1. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on good numbers. Question on, you had a good Q2, but how are you seeing the remaining second half, and what are the initial fillers in October? Are you seeing continued demand for chronic? You were also mentioning about some rebound in acute. If you could give some color how October has been so far.
So, Prakash, we got the report yet. AICD report came in the morning. They have started giving weekly reports. So the report which came in the morning indicates 7% growth for the IPM for the entire month, and Eris 20% growth for October. So as I said, to the last caller, that this is a structural change which is of great benefit to the portfolio which we have. So with this, the portfolio should keep on performing, better and better in the future. Now, regarding the acute, yes, acute we have written in the presentation that we have arrested the degrowth. So we have our degrowth is lesser than the market. It has happened after a long period of time. It is not that we have done some great job. It has bottomed down actually, and we have seen some green shoots. So we are positive of beating the market even in that segment in the coming quarters.
Okay, thank you for that. And secondly, if you see the generics business, I mean, if you look the console minus standalone, so is this run rate is about 100 crores annualized. So is that what you are looking at for the year, and what is the outlook for next year?
Next year, Prakash, we haven't done the exercise till now. So next year number I will not be able to comment. But yes, this business is now catching up. We had certain issues with one of the category of the products. So that and we've been able to do it away with more of A&M even in the generic OTC business. So I am not sure about 100 crores. 80 to 100 crores is the number which I will put. The other, I think, Prakash, there is an Africa also which is sitting in between. When you minus the console from this, there is an Africa also sitting there, and I think on the 7th slide we have a breakup also.
Understood. And lastly, on the cash, since you said that you will maintain 85% plus kind of cash conversion, so is there any plan to use the cash, or you did first quarter for dividends? But is there any plan for the remaining year? You're scouting out for more assets, brands. What is the thought there?
So Prakash, there are two things which are running parallelly. One is that our pipeline is quite robust, and out of these 7 products, at least 4 of them have a real big scope. So I personally feel that we would rather be busy in the next year, at least for the first 2 quarters, in trying to settle down this new product. So from where I'm sitting today, I really don't see something great happening, at least in the first half of the next year. Beyond that, we'll have to wait and watch. And in case we've already announced that, we will do at least a 20% kind of a dividend. In case we don't see opportunity to invest cash, then we will have a rethink on that.
Okay, perfect. Thanks and all the best.
Thank you.
Thank you. Participants, to ask a question, please enter star and 1 on your phone. The next question is from the line of Hiren Gajjar, individual investor. Please go ahead.
Thank you for the opportunity. First of all, congratulations to the Eris Lifesciences team for the good set of numbers in this challenging time. I would like to know the management view on the 2 aspects. The number one is keeping the incorporation in 2007. The company has been serving Indian domestic market quite effectively and efficiently. And of course, there is still a huge opportunity available in the Indian domestic market, be it future patent expiry, consolidation, in-licensing opportunity.
Excuse me, can I just touch in? There's a little bit echo in the voice. It is not clear. Can you be a little closer away, whatever you do? You're not very clear.
Yeah, is it clear now?
Yeah, now it's started getting.
Yeah. So I would just like to know the management view on the 2 aspects. The first is since incorporation in 2007, the company has been serving the Indian domestic market quite effectively and efficiently. And of course, there are still opportunities which is available in Indian domestic market, be it future patent expiry, consolidation, in-licensing opportunity, strategic acquisition. But for extra leg to growth for shareholder value creation, are you looking at expanding to the new geography outside India in mid to long term? And number 2 is there any guidance on the CAGR growth in the top line and the bottom line over the next 3 to 5 years?
Okay, I'm sorry, but I'm very clear and I've got your question. So, look, thank you for all the good words about the growth in the company. But having said that, we are still 1.2% of the market share. So that gives us a huge opportunity in the Indian market. We are very positive about the Indian story because we still feel in the chronic therapy, the coverage of medicine is still 50% of what it deserves to be. And that's the secular story which has been unfolding from the last 2 decades now. So we remain completely focused on the Indian business. We have no plan of moving outside. As far as the guidance is concerned, we do not give guidance as a policy, but at a broad level, we had maintained that we would like to grow 20 to 30% ahead of the market, and we continue missed that for a couple of years. We are trying to make it up make up for all the losses. And in the 4 to 5 years, we'll see us growing at that level.
Okay. Thank you. Thank you for the answer.
Thank you. Participants, to ask a question, please enter star and 1. The next question is from the line of Gagan Thareja from Kotak. Please go ahead.
Yeah, good evening. Am I audible?
Yes, you are.
Yes. Two questions from my side. The first one is around your brand amortization policy. I think you have an amortization period of 50 years for your intangibles.
Mm-hmm.
So what is the rationale behind choosing such a long time frame for amortization?
Okay. Can you put up all your questions so that we can answer one by one?
Okay. So that is the first one. The second one is if I look at the AIOCD data for your brands over the last 5 years, almost half. I mean, if I knock out the top 20 brands that you report, the balanced brands have not grown at all in the last 5 years. They've stagnated over the last 5 years. And they, even as of today, comprise 45% of your sales or more, which essentially means that unless, you pick up on that tail, it's going to drag your sales growth down in the next 4-5 years because it's still a very heavy chunk of your total sales. So what are you planning to do about that? That is the second one. And the third one is around your tax rate and your capex. If you could, because you're at almost full utilization at your Guwahati plant, and your tax rates are fairly low. If you could give us some idea over a 3 to 5 year time frame, how should we build around these two numbers? And lastly, you've got numerous private entities in the group. What could be the reason behind that? So these are my questions.
I missed the last one, please.
You have fairly numerous private entities within the group. What could be the reason for that?
I'm sorry. I'm so sorry. There's a problem in the line. You're getting little, bugged up. Can you please say the last one?
Never mind. If you could just answer these questions, then I'll get back in the queue and come back for more if I do have.
Okay, as you wish. So, look, first of all, I'll answer the tail brand. I think there is a little bit of an issue there. You've seen that our top 15 brands contribute more than 75% of our business. So it is not, the remaining is not 45%, it is 25%. And it's an amalgamation of all the brands, is an amalgamation of the top line growth. So our top 15 brands and even 20 brands, which go up to 85%, have held the market share. That is the reason we have grown. So I think we have that more clear in the presentation, and we'll be happy to provide you with the same. Now, tax paid, we have the tax rates are very clear to you. Guwahati is still working on less than 50%. We have more than 50% availability headroom in Guwahati itself. We have, we have toned it down a bit in the last quarter or two to, take care of the corona situation. So we have had more number of people staying for lesser time in the Guwahati to manage that, and we have been fairly successful there. The amortization is something which Sachin will answer.
Yeah, so amortization, the policy, the accounting policy that we took before the IPO, because we went for IPO also, that was like 50 years, because we believed before India also that there is unlimited useful life of the brand. There have been brands which have been there for 70 years, 60 years, or 50 years, and still running in pharma and any other space. So we took 50 years as a period and then amortized it equally over that period. That's the policy behind it.
I have a few questions around the answers that you put forth. One is, as far as the tail brands go, I am simply picking up data from AIOCD, which gives, among the top brands, whatever it is, Nearly Safe, Veena, Renilint, India, and so on and so forth. And they've mentioned very clearly what the top 20 brands are and what they constitute, and the rest. So let's irrespective of how you report your sales in terms of top 15 or top 20, all I'm trying to tell you is that, basis all the brand data from AIOCD, 40 to 45% sales comes from brands which are just not growing. So that's AIOCD data. My question is simply that, what do you propose to do about these brands? There can't be an arithmetic argument around the fact that, these are reported brands which are not growing, irrespective of how you classify them.
Oh, so we need to be we need to, I think, offline talk about this, but let me give you an overarching view. So if you see our slide number 1, which says that this is the 9th consecutive quarter where we have done better than the market in VNM, in cardio, and in diabetes, which contributes 80% of our business. So and this is an AICD data, 9th consecutive quarter. That means that 80% of our business have been growing better than the market. Now, within that 80%, there could be brands who have done much better. There could be brands which have not done well. So we don't know the maths within that 80%. I'm sure you must have, taken a very careful view. We've also maintained that the top 15 brands, which contribute around 70%, have also followed the same trajectory. So why don't you get offline with Kruti and then, thrash it out?
Okay, and as far as the brand amortization goes, I'm wondering how many brands, in pharma would have had a 50 to 70 year life, especially given that, we are not talking about brands per se, but branded generic drugs per se, and it's a fairly cluttered market where in the therapeutic areas that you are present, practically each of these cardio or diabetic sub-therapy groups that you would be there would have more than a double-digit number of competitive products. So, I fail to see the argument for a 50-year amortization period of brands. I mean, these are not brands in the sense of, being innovative or consumer products. They are brands maybe as we call them colloquially, but they are actually branded generic drugs.
Yeah, you are right, but the fact is that we are full of examples of brands who have lived more than 50 years, right? I don't have the exact data, how many of them have done, but if you're interested in that, we can send you. It is very simply available. My last understanding was that, almost 50% of the brand in top 300 are more than 30 years old.
Finally, from my side, why have you followed an acquisitive growth policy rather than an organic growth policy? I mean, all your growth in the last 3-4 years, whatever you've reported, is essentially coming from you acquiring brands rather than, growth coming organically from your brands. I do understand that acquisitive growth could be a bolt-on strategy for, a company which is run through the life of its best brands and obviously therefore they need to go in for acquisition. But you are a fairly small company. And if you consider that your brands are going to have 50 years of life, I'm sure, you believe there's growth potential, and then why not go for organic growth rather than simply going in for an acquisitive model?
So factually, in our top 15 brands, there's only one brand which has come from acquisition. The 14 have been organic.
How much of your reported sales is from the past acquisitions, if you could give an idea?
No, we don't give that from the last 1.5 years.
I'm simply trying to understand in terms of, a proportion, a ballpark proportion, what portion of your sales today comes from the acquisitions that you would have done over the last 5-6 years?
We haven't done that math, but in the ICD data, you can pick that up. If you ask us, our IR will do that job for you. But you can pick that up from the ICD. They bifurcate the brand from the original company also. So they still report slide with slide. So there's no problem there. If you want that breakup from the ICD, we'll be happy to break it up and give it to you.
Yeah, no. So I asked that question because I feel that a significant proportion has come from simply acquisitions rather than organic growth. So I'm wondering, how do I reconcile these two?
No, that unfortunately is true, but we will be happy to give you the breakup. The LCD breakup.
Okay, thank you. I'll get back in with you.
Thank you. Participants, if you have any questions, please enter star and 1. The next question is from the line of Aditya Khemka from InCred AMC. Please go ahead.
Hi, thanks for the opportunity. And just a couple of questions for Amit, sir. Sir, on the ground level, in terms of activity, promotions, MRs going out to meet doctors, etc., where are we compared to pre-COVID times now?
I said around 90%.
90%?
Yes.
Okay. And would you say that your conveyance and traveling expenditure, etc., basically the part of other expenses which alludes to conveyance, traveling, promotion, that has also come back to 90% of the pre-COVID level? Is that a fair assumption to make?
Absolutely fair.
Fair enough. Secondly, on the specialist sales, on your chronic sales, now with most of the sort of being more hesitant in terms of entertaining patients, having queues in front of their cabins, doing online consultation, also scheduling patients as per, more distancing, etc. You feel that the volume of prescriptions being generated now has more or less normalized in the chronic segment, or do you feel it is still suppressed because of the doctor behavior or the social distancing or the lack of online penetration into the medical practice?
Yeah. I'll answer all your questions. Just get me the other one also.
Yeah. So the last question I had was in terms of the Strides acquisition. I know we don't break out the Strides numbers, but if you could just help us, if you were to look at the acquisition of Strides today, when you look back at it, is there something you would have done differently, or has it played out, to the best of its ability that it could have, obviously keeping COVID aside?
Okay. So look, specialists at the super specialty level, the patients have started coming back. At a very super specialist level, the patients are back almost 80% now, and there is a mix. Now the new normal is, too much adherence to appointments so that people don't get together. So everybody is practicing that very well. There is a distancing which people do in their own way, especially the treating doctor. Make sure that he distances himself and wear all the protective gear. But patients have started coming back. At least 80% in the super specialty are back. The volume of prescription, as I told you, is 80%. Then the same stands true for the volume of prescription also. From the Strides acquisition, what I would like to tell you is, look, Strides and Eris today is baked into our standalone. If you look at our standalone, it is 40% EBITDA, am I right? Mm. It's 40% EBITDA, which is where original Eris was. So that's how we have amalgamated, and that's how profitable it has become.
Right, understood. Just one add-on question, if I may. In terms of pricing levers of some of your leading brands, Glimisave, etc., where do we stand compared to our competitors' end product prices? And are there enough levers for you to take like 5 in your leading brands?
So the lever for us to take a price increment basically depends upon where the market is growing. So we basically look at the market and then take a call, which is subjective in nature. As far as the pricing strategy is concerned, I have alluded to this fact that we are more or less in the first quadrant, but below in the first quadrant.
Okay, so just to sort of dig more into that, so if competition ends up taking price increase of 5%, would you generally go the 5%, or would you do lesser than 5% in your brand?
We'll be at the same point, more or less.
Similar point. Understood. Thanks for answering my questions, Amit, and all the best.
Thank you.
Thank you. Participants, if you have any questions, please enter star and one. Ladies and gentlemen, to ask a question, please enter star and one. We have a question from the line of Aniket Kanwatkar from Sri Vikram Consultant. Please go ahead. Aniket, you may proceed with the question, please.
Hello.
Aniket, please proceed with your question.
Hello.
Yes, we can hear you.
Yeah. Thank you for the opportunity. So, sir, I have a question on Zomelis. So, could you share the revenue numbers for Zomelis in the quarter?
Yeah, it's around 10.6, 10.8. 10.6. Yeah, 10.7 actually.
Okay. Sir, and could you help me understand what was the revenue for Africa in last quarter?
It is already mentioned in the presentation, but if you insist, we'll just let you know. I think it is 14 crores. 14 and a half crores.
14.7.
14.7 crores.
Okay, sir. Got it.
Thank you. Ladies and gentlemen, to ask a question, please enter star and one. As there are no further questions, I would now like to hand the conference over to Mr. Amit Bakshi for closing comments.
So thank you so much for being patient in the call, and see you in the next call then. Thank you. Bye. All the best.